Hi guys, this is Liz Brown with Richland College. We are going to work a bond problem. We have Twister Entertainment. They are issuing bonds on January 1st of 2021 at $600,000. They mature in 20 years, paying an interest rate of 8%. The interest is payable twice a year, every 6 months, so June 30th and December 31st. Let's talk about the rates. When we see a rate here of 8%, this has to be the stated rate, okay? The rate that is given is the stated rate. We are going to do this problem under 3 different assumptions. First, the market rate is 8%. Second, the market rate is 9%. Now here, we're giving you the issue price. Third, market is 7%. Issue at, and then here's our price here. Now we need to calculate our briefcase of cash. This is going to be paid twice a year, so each 6 months. Which rate are we going to use? We have market rate and we have our stated rate. The briefcase of cash is always driven by the stated rate. So let's drop this rate in here. 8% can be written 0.08. Now, as mentioned earlier, one of the trickiest things of this bond is to note we are paying it each 6 months. So we need to divide this rate into 2 pieces because we are doing it twice a year. The rate that we're going to be using is 0.04 because we're making the payments twice a year. This calculation here is simply our 600,000 times 0.4 to get us 24,000. Another extremely important piece. This briefcase of cash, or the cash payment every 6 months that we are making, is the same no matter what the market rate is. If we have a face value bond, a discounted bond, or a premium bond, you will see that we are paying $24,000 in our cash, which I like to refer to as the briefcase of cash, every 6 months. Now, let's look at this bond in face value. Face value means the market rate is the same as the stated rate. So let's do this problem. I have T accounts here. I find T accounts to be extremely helpful when doing these bond calculations. So once we populate these T accounts, we will also do the journal entries. On day 1, when we issue the bond, under face value, the market rate is 8%. We are going to issue a bond for $600,000 and we will receive $600,000 in cash as well. So let's go in here and record $600,000 in our bonds payable and $600,000 in our cash. So bonds payable is increasing by $600,000 and cash is also increasing by $600,000. We're seeing our journal entry here on January 1st. Cash, $600,000, bonds payable, also $600,000. Let's do our first interest payment on June 30th. Our rate that we're using is the market rate. The market rate is 8%. We are using it every 6 months. Don't forget to divide that market rate by 2, so 4%. Our interest is being calculated here for us as the bond payable balance times our 4%, or $24,000. How much are we paying in our briefcase of cash? It is the same, $24,000. This bond is going to look very similar to other note payable instruments we have used. Let's increase our interest expense by $24,000, and we are going to pay out cash of $24,000. So debit increases our expense, and a decrease to cash of $24,000 is done with a credit. Let's do those journals. As you're seeing here, interest expense $24,000, cash is $24,000. When it comes time to pay our December 31st interest expense, it's going to be the same calculation. The bonds payable is still valued at $600,000. Our interest rate is still 0.04% or 4%, and our interest will be $24,000. So that interest expense is going to be the same, and our cash payment is always going to be that briefcase of $24,000 in cash. Let's take a look at that journal. As you can see, it is the same journal entry that we did in June that we're doing in December. Let's take a look at our next assumption here, number 2. The market rate is 9%. Our stated rate is 8%. So our bond is paying 8% in briefcases of cash. Other bonds of similar risk are paying 9%. The market will only pay us $544,795 for our bond, which is less than this issue amount. What we have here is a discount. Our goal here is to take our bond, which is being issued at less than face value, and at the end of the life, after we amortize our discount, we will pay back the face value. So what we have here is we're going to receive $544,000, and at the end of the 20 years, we are going to pay back $600,000. Let's do the discount. We know that our bonds payable will be $600,000, and that is what we're going to owe at the end of the 20-year period. We are going to receive $544,795. The difference between these two is going to be our discount. Let's go ahead and put this into the journal entry and see what it looks like. Our cash that we're given is this $544,000. What we owe at the end of the life is the $600,000. We know the difference is our discount on our bonds. Which direction should it be? Do we need to increase our debit side or our credit side? In this case, we need to update our debit. Let's go ahead and do this calculation. I'm going to use a calculator. Join me. I'm going to take $600,000 and I'm going to subtract out this cash. The balance is $55,205. This is what we need our discount to be on our bonds payable to make this side of the journal entry match this side. Note that this is a debit. Let's take a look at the T account. Here is our discount balance, $55,205. Note, this is a debit balance. Discount is a contra payable. Together, these are going to calculate our carrying value. Our bond is $600,000. Our discount is $55,205. Our carrying value of the bond is the same amount as the cash that we received here. Let's go ahead and calculate our first interest payment on June 30. What rate will we use to calculate our interest? Stated rate or our market rate? We are going to use our market rate. Market rate will always be the rate we use to calculate interest. I'm going to come in here and drop in 0.09 as our rate. Now, please note, we have divided this number by 2 to give us 0.045 because we are doing our interest every 2 months. You're also seeing this calculation here for our interest. Let's go ahead and do it again together. We're going to take our carrying value of our bond, which is $544,795, and we're going to multiply it by our 6-month interest rate. That is going to give us $24,515.78. This is our interest expense. So let's go ahead and put this number up here. This is our interest expense. Now, what else do we know? If this is interest expense, how much am I paying in that briefcase of cash? Do not forget, the briefcase of cash is always the same no matter if we're using face value bond, a discount bond, or a premium bond. We will always use $24,000 as the briefcase of cash. Let's refresh ourselves. It is calculated in this manner. Stated rate divided by 2 times our $600,000 that our bond is worth. Let's populate those journal entries. We calculated our interest expense as $24,516. We know that we're always going to pay $24,000 as our briefcase of cash, but our journal entry does not balance. What we're missing is an adjustment to our discount on bonds payable. Which direction does this need to be to make our journal entry balance? As we can see here, it needs to be 516 on the credit side. Let's update our T account for our discount of 516. 516 is going to give us a new discount balance of $54,689. Note that discount started off with a debit balance, and we are crediting it and therefore decreasing it to $54,689. Let's calculate our interest for the December period. Our bond is still $600,000, and our discount is now different. We're going to pull over our new discount balance of $54,689, giving us a new bond carrying value of $545,311. Let's calculate our interest. We are going to take our bond's carrying value multiplied by our rate. This is going to give us interest of $24,539. Let's go ahead and add that up here in our T account. So what we're going to do is we're going to pay interest expense of $24,539. We are also going to pay that briefcase of cash, which is always $24,000. Let's go ahead and calculate what our discount will change by using the journal entry. Here is our journal. Interest expense, the number we calculated. Cash, we're always paying that $24,000. And the change to our discount needs to be $539 for our journal entry to balance. Let's go update that T account. We've dropped in the $539 and we see our new discount balance. Now I want you to see what's happening here. What is happening with our interest expense? Our interest expense is increasing over time, very slightly, because our bond value is growing over time. Remember, our goal on that chart is to get the carrying value of this bond to go from $544,000 all the way to $600,000 that we will pay at the end of the life. Look what's happening to our discount. It started off as $55,205. We are chipping away at it each month, and it is growing or shrinking. It is shrinking. Right now, it started at $55,000. Now it's $54,000. Our goal here is to make this discount account go to zero, to get smaller and smaller over time. At the end of the life of this bond, we want our bond to be worth $600,000, our discount to be worth zero, so that we can pay back the full amount of the $600,000.